Before we do our video, I'd just like to say, if you found these videos to be helpful and informative as things change dynamically and on a daily basis, please feel free to share this with your friends and family who may have advisors that aren't communicating with them, that aren't helping them understand fact from fiction. We'd encourage you, any kind of important friend or family member that you'd like to help put at ease, please share these videos. Hope you like this next one. Hi, clients and friends. Here we are, Thursday, March the 12th, and no surprise to any of us, we're off to another wild ride in the markets. The market opened at down nearly 2,000 on the Dow after President Trump's address last night. Before we talk about what that may or may not mean, I want to remind us of a couple of things. The first is, in our video we sent out yesterday, we were fully anticipating that the market could leg down another 10% or so. And here we are. But before we go into putting that into context for today, let's go back to a couple of historical events that I think are pretty important. 1996, Chairman Alan Greenspan talked about irrational exuberance. And fast forward a couple of years into 2000, Kudlow and Cramer had a show, and Jim Cramer famously said, "The old economy is gone, valuations are out of the window, this is the new normal." They had that NASDAQ vial that they filled up, NASDAQ 10,000, here we come, and as you probably remember, the dot-com bubble. 2008, in the financial crisis, we had banks that had toxic debt. We were over-leveraged, and the underlying real estate bubble had created a significant risk to the average consumer. Let's fast forward now to 2020. Banks are very well capitalized. In fact, corporate America's balance sheets are as fat as they've been in decades. Profits are incredibly strong. And instead of irrational exuberance, like we saw in the 90s in the dot-com bubble, what we're seeing now is irrational emotions. This movement in the market is so far detached from the underlying economic fundamentals that for most investors, it feels like all of these other chaotic and large swings downward in the market, but the economic data says that couldn't be farther from the truth. So, what does that mean? Well, we're going to have just a minute where our chief investment officer, Scott Pyle, spends a few minutes talking through the logistics of that. But I want to pivot for a minute to the coronavirus. In 2009, which is the last widespread pandemic that the World Health Organization issued, it was the H1N1 virus, or the swine flu, as it's commonly known. 60 million Americans, 60, is what the CDC estimates were infected with the swine flu. 60 million people. And globally, estimates are as high as 575,000 deaths. But 75% of people don't even remember it. Want to know why? Facebook was just getting off the ground. There was no Twitter, there was no Snapchat, and there was no Instagram. What we're seeing now in the markets is a social media pandemic. There's nearly 3 billion Facebook users worldwide. So whether you're in a small Italian village or you're in the communist country of China, you're able to update the rest of the world as to what's going on. Whether or not that has any indication or implication in your country of residence, it still affects us emotionally. And I am in no way, Scott, myself, our team, are in no way making light of the tragedy of the loss of life or the sickness or the emergency workers that are putting themselves at risks. But I want to make sure that we put this into proper context. We are fundamental investors, and we refuse to submit to a blatantly false, half-truthed, or inaccurate narrative. The data drives our investment decision, not politics, not World Health Organization. Now, we don't want to minimize the effects that could have, because what is everyone's chief fear? Aside from the health-related risks, everybody is concerned that consumer spending will go to nothing. That we will, as a largely, and the latest numbers suggest that we're about a 75% consumer-based economy, that we'll stop consuming. But I can tell you, if we do get to the point where we need to be virtual or quarantine or whatever that may look like, I'm still going to get up and drink my coffee. Many of you know I love Diet Mountain Dews. I'll still be drinking those. My family will still have to eat. Certain industries will certainly be impacted by that. The airlines, the cruise ships, but we will still consume. And so when we get on the other side of this, we're going to be able to look back and learn some valuable lessons, just like we did in 1987, 1996, 2000, 2001, 2008. But let's stop for a moment and speak really specifically at the gyrations and volatility. So what I want to do now is let's turn to Scott, who is really running the entire technical dynamic investment decision making that we are executing in these moments. Okay, Scott. Help our clients and our friends and family understand what's going on with these gyrations and where we are in the market right now.
Yeah, well, with the president speaking last night, and we see another big move down, we could possibly be here a little longer than we expected. And so one of the things we're doing in our portfolios, and our clients have experienced this, is we're buying good dividend paying stocks because we want to get paid while we wait.
That's right.
If we're here a little longer than we expected. But as the disease, if you will, the virus moves through the U.S., it's interesting how a lot of corrections, or now they're calling this a bear market, they're talking about potential recession, are usually caused by bad economics.
That's right.
Bad financials. Well, the economy was very strong, actually robust and growing prior to this, just in January. So once the virus works its way through our population, the other side, we expect it to be quite quick on the recovery. Some of our economists, as we've talked about, are calling for the S&P to even finish the year positive by double digit.
That's right. So if we're here lower for longer, we're trying to own things where we get paid
while we
wait.
Yep.
And then, as you just mentioned, 18 to 36 months from now.
Well, that's the thing, right? So imagine going 18 to 36 months in the future and looking back on these prices. I think everyone would be going, why didn't we buy? Yeah. How could we have bought
That's
more?
Right. Because we're essentially at Christmas Eve 2018
That's right.
today.
And we really just went through this 14 months ago. And wow, was the other side great.
That's right.
And by preparing, and we have cash that we've been putting in, and we've been doing it systematically. At each level where we're hitting support in the markets, we go in and we buy at better prices. And our dividends and our yield just keep getting better as prices get cheaper. And then as we get towards the end, we'll hold cash for that just in case.
That's right. And so our team collectively has nearly 175 years worth of experience, but you specifically, in your nearly 30-year career, this kind of environment isn't foreign to you.
No, I mean, all the sellers have sold. What happens?
The buyers buy.
The buyers buy.
That's right.
And everyone we're talking to out there that we know are buying, they're coming to us saying, is now the moment, is now the moment, is now the moment, versus, should I get out?
Ripcord, yeah.
So you're seeing a lot more buying, and that's why we've had these stair steps going down, and we kind of want that last final fear, just this is it, it's the end of the world, get out.
Yeah.
And we saw a little bit of that this morning.
We did. So this economy makes this episode, if you will, starkly different than 08, 01, 96,
sure.
Right?
Yeah.
We were talking just a minute ago. What was that Warren Buffett quote?
Yeah, I love that one, right? So when everyone is greedy, be fearful. And so we were taking profits at the highs, and that's why we were building cash. And then the other part of that quote is when everyone is fearful, be greedy. And so we're looking at what we want to own 18, 36 months from now.
Yep.
We're being very sensitive to dividends, so we get paid while we wait.
That's right.
And we're being greedy by putting that cash to work that we pulled aside.
That's right. So again, this is something we'll continue to update you as we get informative and useful information. But if you need anything from us, any one of our team members in the meantime, call us, email us. We're ready to walk through how this applies at the individual level. But unless something meaningful happens, we'll check in with you at the beginning of next week.